Question 1. Risk assessment and selection criteria. Which of the following is most critical in assessing the suitability of a risk for a captive insurance company? A. The volume of premiums collected by the captive. B. The volatility and predictability of the risk profile. C. The reinsurance agreements in place for the risk. D. The regulatory requirements for captives in Nevada. Answer. B. The volatility and predictability of the risk profile. Explanation. When assessing the suitability of a risk for a captive insurance company, the most critical factor is the volatility and predictability of the risk profile. Captives are designed to manage risks that align with the company's overall risk strategy. A predictable and stable risk profile allows the captive to effectively set reserves, price premiums, and manage claims. Highly volatile risks may require additional capital reserves and reinsurance to maintain solvency. While premium volume option A is relevant, it is not as crucial as the underlying stability of the risks. Reinsurance agreements option C and regulatory requirements option D are important but secondary to understanding the risk's nature. Question 2. Scenario-based question. Captive formation. Mr. Thompson, the CEO of a manufacturing company, is considering forming a captive insurance company to manage his firm's rising insurance costs and improve coverage for specific operational risks. He has already completed a feasibility study which highlights potential savings and risk control benefits. What should be Mr. Thompson's next step in the process of establishing a captive insurance company in Nevada? A. Obtain approval from the Nevada Department of Insurance to form the captive. B. Create a business plan outlining the captive's operations, coverage, and governance structure. C. Start marketing the captive insurance company to potential policyholders. D. Begin collecting premiums from the business's divisions. Answer. B. Create a business plan outlining the captive's operations, coverage, and governance structure. Explanation. After completing a feasibility study, the next critical step in forming a captive in Nevada is creating a comprehensive business plan. This plan should outline the captive's operations, including coverage lines, risk management strategies, governance structure, and financial projections. The Nevada Department of Insurance requires this detailed plan to assess the viability of the proposed captive. Obtaining approval, option A, can only occur after the business plan is prepared and submitted. Marketing the captive, option C, and collecting premiums, option D, should only happen once the captive is operational and licensed. Hence, Mr. Thompson must first prepare and present the business plan before proceeding further. Question 3. Taxation of captive insurance. Which of the following is true regarding the federal tax treatment of a Nevada-domiciled captive insurance company under Section 831? B. A. Captives that elect Section 831. B. Are taxed on the premiums received from related parties, regardless of the amount. B. Captives are exempt from paying taxes on the premiums received, but must comply with all state tax regulations. C. Captives can elect to be taxed only on premiums that exceed $2.2 million, with the remainder being tax exempt. D. Captives electing Section 831. B. Are taxed based on their total income from premiums and investments. Answer. C. Captives can elect to be taxed only on premiums that exceed $2.2 million, with the remainder being tax exempt. Explanation. Section 831B allows small captives to elect to be taxed only on premiums received in excess of $2.2 million. This tax election applies to captives that provide insurance to related parties and are established to help businesses reduce insurance costs while maintaining risk management control. The $2.2 million threshold is the key feature of this provision, allowing smaller captives to avoid taxation on premiums below this amount. Option A is incorrect because the tax exemption applies only to premiums below the $2.2 million limit. Option B is incorrect because state taxes still apply. Option D is incorrect because captives electing Section 831B are not taxed on their total income but only on premiums over the $2.2 million threshold. Question 4. Captive insurance governance and management. Which of the following best describes the role of a captive insurance company's board of directors? A. The board is solely responsible for handling all claims and underwriting decisions. B. The board oversees the overall governance of the captive, including financial reporting, risk management, and compliance. C. The board is not required to be involved in the management of the captive as it is handled by the captive manager. D. The board's primary role is to make investment decisions for the captive's portfolio. Answer. B. The board oversees the overall governance of the captive, including financial reporting, risk management, and compliance. Explanation: the board of directors of a captive insurance company is responsible for the overall governance of the captive. This includes overseeing strategic decisions related to financial management, risk management, compliance with regulations, and ensuring that the captive operates in the best interests of its owners. While the captive manager may handle day-to-day operations such as claims handling and underwriting, option A, the board remains responsible for ensuring the captive's adherence to laws and regulations, including financial reporting and risk management practices. Option C is incorrect because the board plays an essential role in overseeing the captive, not just in passive oversight. Option D is also incorrect since investment decisions, while important, are a smaller part of the board's comprehensive governance role. Question 5. Risk management and underwriting. Which of the following is most important when setting premium rates for a captive insurance company? A. Premiums should be set at the lowest rate to maximize profitability for the parent company. B. Premiums must reflect the full risk profile of the insured entity, considering both the likelihood and potential severity of claims. C. Premiums should be set based on the overall risk of the market, regardless of the individual captive's characteristics. D. Premiums are generally set based on industry standards, without regard for the specific risk characteristics of the insured. Answer: B. Premiums must reflect the full risk profile of the insured entity, considering both the likelihood and potential severity of claims. Explanation: when setting premiums for a captive insurance company, the most important consideration is accurately reflecting the full risk profile of the insured entity. This includes assessing both the probability of a claim occurring, likelihood, and the potential financial impact, severity of those claims. This allows the captive to collect appropriate premiums that can cover its liabilities while maintaining solvency. Setting premiums too low, option A, could lead to inadequate reserves while relying solely on market-wide rates. Options C and D ignores the unique risk profile of the captive's parent company. Therefore, premium rates should be tailored to the individual risks of the insured entity. Question 6. Scenario-based question. Captive insurance claims. Mr. Carter, the risk manager for a large retail chain, oversees a captive insurance company that covers the company's property damage and liability risks. Recently, one of the retail stores suffered significant fire damage, and Mr. Carter is unsure whether the claim should be processed through the captive or through the company's general insurance policy. What should Mr. Carter do first to determine whether the captive should handle the claim? A. Immediately report the claim to the general insurance company for processing. B. Consult the captive's policy document to determine whether fire damage is covered under the captive's terms. C. Process the claim through both the captive and the general insurance policy to avoid any delays. D. Wait for the insurance company to assess the damage before deciding if the captive is involved. Answer: B. Consult the captive's policy document to determine whether fire damage is covered under the captive's terms. Explanation: Mr. Carter should first consult the captive's policy document to understand the terms and coverage limits for fire damage. Captives typically cover specific risks that the parent company identifies as part of its risk management strategy, so it's important to ensure that the fire damage is within the scope of coverage for the captive. Processing the claim through both policies, option C, is unnecessary and could complicate the claims process, potentially leading to disputes about coverage. The general insurance policy, option A, may also have exclusions for certain types of risks that the captive is designed to cover. Waiting for the insurance company to assess the damage, option D, is not ideal as it delays the proper identification of coverage responsibilities. Question 7. Nevada captive insurance law and regulations. What is the main advantage of domiciling a captive insurance company in Nevada compared to other states? A. Nevada provides captives with a higher premium tax rate than most states, making it a more profitable option. B. Nevada offers favorable regulatory fees and incentives, along with a supportive captive insurance infrastructure. C. Nevada requires captives to have larger capital reserves than other states to ensure higher solvency. D. Nevada imposes less stringent reporting and compliance requirements for captives compared to other states. Answer: B. Nevada offers favorable regulatory fees and incentives, along with a supportive captive insurance infrastructure. Explanation: Nevada is considered a favorable domicile for captive insurance companies primarily due to its supportive regulatory environment, low regulatory fees, and various tax incentives designed to attract captives. The state has developed a robust infrastructure to support captive insurers, which includes offering competitive licensing fees, ease of regulatory compliance, and a proactive approach from the Nevada Department of Insurance. Option A is incorrect because Nevada's tax rate is generally competitive, not higher. Option C is also incorrect because Nevada does not require captives to have excessively large reserves, but instead ensures that captives meet reasonable solvency requirements. Option D is incorrect as Nevada's reporting and compliance requirements are stringent but are balanced with regulatory incentives. Question 8. Taxation of captive insurance. Under Section 831, B. Which of the following would cause a captive insurance company to lose its tax-exempt status for premiums under $2.2 million? A. The captive fails to maintain sufficient solvency ratios as determined by the Nevada Department of Insurance. B. The captive writes policies for unrelated third parties without meeting the IRS's related party rules. C. The captive fails to file an annual tax return with the IRS. D. The captive receives an amount of premiums that exceeds $2.2 million. Answer. B. The captive writes policies for unrelated third parties without meeting the IRS's related party rules. Explanation. To qualify for Section 831B and be taxed only on premiums above $2.2 million, the captive must meet the IRS's related party requirements. If the captive writes policies for unrelated third parties without satisfying these requirements, it will lose the tax-exempt status for premiums under the $2.2 million threshold. Option A refers to solvency ratios, which are important but not directly tied to tax-exempt status under Section 831B. Option C is incorrect because failing to file an annual return does not automatically disqualify a captive under Section 831B. Option D is incorrect because a captive is allowed to write up to $2.2 million in premiums without triggering tax liabilities for those premiums. Question 9. Captive insurance financial management. Which of the following is a common investment strategy for a captive insurance company? A. Investing primarily in equities to maximize returns on capital. B. Focusing exclusively on low-risk liquid assets to ensure solvency. C. Utilizing reinsurance arrangements to diversify the investment portfolio. D. Relying on the parent company's investments rather than independently managing assets. Answer. B. Focusing exclusively on low-risk liquid assets to ensure solvency. Explanation. A common investment strategy for a captive insurance company is to focus on low-risk liquid assets. Captives need to ensure they maintain enough liquidity to pay claims as they arise, so investing in stable liquid assets such as government bonds or short-term instruments is crucial for solvency. While equities, option A, may provide higher returns, they introduce more volatility, which can pose risks to the captive solvency. Reinsurance, option C, is not typically used as an investment strategy but as a risk management tool. Relying on the parent company's investments, option D, is not a good practice for captives as it may expose the captive to unnecessary risks and limit its independence. Question 10. Reinsurance and captives. Which of the following is a primary reason a captive insurance company might enter into a reinsurance agreement? A. To reduce the amount of underwriting risk retained by the captive. B. To increase the amount of premiums written by the captive. C. To improve the captive's solvency margin by taking on more risk. D. To avoid paying taxes on premiums received by the captive. Answer A. To reduce the amount of underwriting risk retained by the captive. Explanation. Reinsurance agreements allow a captive to transfer a portion of its underwriting risk to another insurance company. This helps reduce the exposure to large losses and provides additional financial stability. Option B is incorrect because reinsurance does not directly impact the amount of premiums written, but rather helps manage risk. Option C is incorrect because increasing risk does not improve solvency. Reinsurance is used to manage and mitigate risk. Option D is incorrect as taxes are not avoided through reinsurance. Question 11. Captive insurance regulation. Which of the following is a typical regulatory requirement for a captive insurance company? A. Captives must provide insurance coverage to unrelated third parties to maintain their status. B. Captives must demonstrate adequate reserves and solvency to ensure they can pay future claims. C. Captives are exempt from state insurance department oversight if they are domiciled offshore. D. Captives must be owned by a publicly traded company to operate legally. Answer. B. Captives must demonstrate adequate reserves and solvency to ensure they can pay future claims. Explanation. A core regulatory requirement for captive insurance companies is that they must demonstrate financial stability by maintaining adequate reserves and solvency. This ensures the captive has enough funds to cover any claims made by its policyholders. Option A is incorrect because captives generally provide coverage to their parent company and affiliates, not unrelated third parties. Option C is incorrect as even offshore captives are subject to regulatory oversight, typically by the jurisdiction where they are domiciled. Option D is incorrect because captives can be privately owned. Question 12. Captive insurance and taxation. Which of the following is true regarding the tax treatment of premiums paid to a captive insurance company? A. Premiums paid to the captive are considered tax deductible for the parent company provided the captive is domiciled offshore. B. Premiums paid to a captive insurance company are always tax deductible regardless of the captive's domicile. C. Premiums paid to the captive are tax deductible for the parent company if the captive is considered a real insurance company under IRS rules. D. Premiums paid to a captive insurance company are never tax deductible for the parent company. Answer: C. Premiums paid to the captive are tax deductible for the parent company if the captive is considered a real insurance company under IRS rules. Explanation: under IRS guidelines, premiums paid to a captive insurance company are tax deductible for the parent company if the captive is structured and operates like a genuine insurance company. This includes meeting requirements such as risk distribution and risk transfer. Option A is incorrect because being domiciled offshore alone does not guarantee tax deductibility. Option B is incorrect because tax deductibility depends on whether the captive meets IRS criteria. Option D is incorrect because when properly structured, premiums can be deductible. Question 13. Captive insurance operations. Which of the following would most likely be a reason for a company to form a captive insurance company? A. To take advantage of favorable underwriting profits from unrelated parties. B. To have more control over its insurance costs and coverage options. C. To avoid regulatory oversight by the state insurance department. D. To provide insurance to competitors in the same industry. Answer: B. To have more control over its insurance costs and coverage options. Explanation: a key reason a company forms a captive insurance company is to have more control over its insurance costs and tailor its coverage to meet its specific needs. Captives allow companies to better manage their own risks and take advantage of potential savings. Option A is incorrect because captives typically provide coverage for the parent company and its affiliates, not unrelated parties. Option C is incorrect as captives are still subject to regulatory oversight. Option D is not a primary goal of forming a captive, as it is not common for captives to provide coverage to competitors. Question 14. Scenario-based question. Captive insurance claims: a large manufacturing company XYZ Corp. has established a captive insurance company to cover its workers' compensation and property damage risks. The company is faced with a series of high-value claims, including a fire at one of its facilities. The board of directors is concerned about the captive's financial stability and is considering a reinsurance arrangement to help absorb some of the claim costs. What should the board consider when entering into this reinsurance agreement? A. Whether the reinsurance company is financially stable and can pay out claims if necessary. B. The potential for increasing premiums paid by XYZ Corp. as a result of reinsurance. C. The legal requirements for reinsurance agreements in XYZ Corp's domicile state. D. All of the above. Answer: D. All of the above. Explanation: when entering into a reinsurance agreement, the board of XYZ Corp. should consider the financial stability of the reinsurance company to ensure it can honor its obligations in the event of a large claim. Option A. Additionally, they should evaluate the potential impact on premiums. Option B. As reinsurance costs could affect the financial performance of the captive, it is also important to consider the legal and regulatory requirements for reinsurance agreements in the domicile state. Option C. Therefore, all of the above considerations are important. Question 15. Captive insurance financial statements. What is the primary purpose of preparing financial statements for a captive insurance company? A. To report to the parent company's shareholders about the captive's profitability. B. To ensure compliance with tax regulations and solvency requirements. C. To calculate the amount of premiums the captive should collect from the parent company. D. To determine the dividend amount to be paid to the parent company. Answer: B. To ensure compliance with tax regulations and solvency requirements. Explanation: the primary purpose of preparing financial statements for a captive insurance company is to ensure that the captive complies with regulatory requirements, including solvency rules, and to meet tax regulations. Financial statements help regulators, auditors, and tax authorities assess the financial health of the captive. Option A is not the primary purpose, as financial statements serve a broader audience than just shareholders. Option C is incorrect because premium calculation is a separate process, not solely based on financial statements. Option D is incorrect, as dividends are not typically paid out of captives unless there are excess profits. Question 16. Captive insurance and solvency. What is the main reason for a captive insurance company to maintain a strong solvency margin? A. To avoid paying taxes on premiums collected by the captive. B. To ensure that the captive can meet its obligations in the event of large claims. C. To attract third-party business and increase profitability. D. To reduce the amount of capital needed to support the captive. Answer. B. To ensure that the captive can meet its obligations in the event of large claims. Explanation. A strong solvency margin ensures that a captive insurance company has enough financial reserves to meet its claims obligations, even in the case of large or unexpected losses. This helps maintain the financial health of the captive and provides security to the parent company. Option A is incorrect because solvency is unrelated to avoiding taxes on premiums. Option C is incorrect as the solvency margin is mainly focused on the captive's ability to cover its own claims, not third-party business. Option D is incorrect because reducing capital reserves may jeopardize solvency. Question 17. Captive insurance investment risk. Which of the following types of investments is most likely to be considered risky for a captive insurance company's portfolio? A. Treasury bonds issued by the U.S. Government. B. Corporate bonds from highly rated companies. C. Equities in emerging markets with high growth potential. D. Municipal bonds issued by a stable city or county. Answer. C. Equities in emerging markets with high growth potential. Explanation. Investing in equities in emerging markets is considered more risky due to the volatility and potential for significant financial loss. While these investments offer high growth potential, they also come with increased uncertainty. In contrast, Treasury bonds option A and municipal bonds option D are typically low-risk investments, and corporate bonds from highly rated companies option B are also less risky than equities in volatile markets. Captive insurance companies tend to avoid high-risk investments to ensure sufficient liquidity and solvency. Question 18. Captive insurance and corporate governance. Which of the following is a key responsibility of the board of directors of a captive insurance company? A. To underwrite policies and set premiums for the captive. B. To review and approve the captive's investment strategy and risk management policies. C. To handle all claims directly and approve settlements. D. To establish the captive's tax strategy, including deductibility of premiums. Answer. B. To review and approve the captive's investment strategy and risk management policies. Explanation. The board of directors of a captive insurance company is responsible for overseeing the strategic direction of the company, which includes reviewing and approving its investment strategy and risk management policies. This ensures that the captive operates in alignment with its long-term goals and remains financially sound. The board does not typically handle day-to-day tasks like underwriting policies option A or directly managing claims option C, though it may oversee claims processes. While the board may play a role in reviewing tax strategy, it is usually not responsible for establishing the specifics of tax deductibility for premiums option D, which is more often handled by the captive's legal and financial advisors. Question 19. Captive insurance and risk retention. Which of the following best describes the primary advantage of risk retention (RRGS) in the context of captive insurance? A. RRGS allow a group of companies with similar risks to pool resources and share the cost of insurance. B. RRGS are designed to provide insurance exclusively to external, unrelated third parties. C. RRGS are subject to minimal regulatory oversight by state insurance departments. D. RRGS allow individual companies to avoid paying taxes on premiums paid to the group. Answer A. RRGS allow a group of companies with similar risks to pool resources and share the cost of insurance. Explanation. Risk retention (RRGS), a type of captive insurance company that allows multiple organizations with similar insurance needs to pool resources and share the costs and risks of providing insurance. This model allows smaller companies to benefit from the purchasing power and risk diversification that larger insurers typically enjoy. Option B is incorrect because RRGS are intended to provide insurance to members of the group, not unrelated third parties. Option C is incorrect, as RRGS are still subject to regulatory oversight, although they may be regulated differently than traditional insurers. Option D is incorrect, because taxes on premiums are not avoid RRGS, as they are subject to taxation and regulatory requirements. Question 20. Captive insurance and claims management. Which of the following is a primary consideration for a captive insurance company when establishing its claims management process? A. Ensuring that claims are handled exclusively by the parent company's legal department. B. Developing a strategy for the efficient resolution of claims, including both internal and external resources. C. Outsourcing claims management entirely to third-party administrators without any oversight. D. Minimizing the number of claims submitted to avoid regulatory scrutiny. Answer: B. Developing a strategy for the efficient resolution of claims, including both internal and external resources. Explanation: a captive insurance company must develop an efficient claims management process that balances internal and external resources, such as claims adjusters, third-party administrators, and legal counsel, to ensure timely and fair resolution of claims. Option A is incorrect, because while legal departments may be involved, claims management typically involves a broader strategy. Option C is incorrect, as outsourcing claims management without oversight could lead to lack of control over claims resolution. Option D is incorrect, because captives are required to report claims accurately, and attempting to minimize claims could result in legal and regulatory issues. Question 21. Captive insurance financial ratios. Which financial ratio is most commonly used to assess the financial health of a captive insurance company? A. Return on equity, ROE. B. Solvency ratio. C. Price to earnings, P ratio. D. Dividend payout ratio. Answer: B. Solvency ratio. Explanation: the solvency ratio is a key measure used to assess whether a captive insurance company has enough capital to meet its long-term liabilities. This ratio helps determine the financial stability of the company and its ability to handle unexpected claims. Option A is incorrect, because return on equity, ROE, is more commonly used to assess overall profitability. Option C is incorrect, because the price-to-earnings P ratio is typically used for publicly traded companies, not captives. Option D is incorrect, because the dividend payout ratio is more relevant for publicly traded companies distributing dividends to shareholders. Question 22. Captive insurance and regulatory compliance. A captive insurance company domiciled in a U.S. state is subject to which of the following regulatory requirements? A. Must provide insurance to unrelated third parties to maintain its status as an insurance company. B. It must comply with the state's insurance regulations, including solvency, reserve, and reporting requirements. C. It must avoid using reinsurance as a way of managing risk to comply with state law. D. It must be governed by a public board of directors. Answer: B. It must comply with the state's insurance regulations, including solvency, reserve, and reporting requirements. Explanation: captive insurance companies, even if domiciled in a state, are subject to state insurance regulations, which include solvency requirements ensuring the company has sufficient assets to cover potential liabilities, reserve requirements setting aside funds to pay future claims, and reporting requirements ensuring transparency and accountability. Option A is incorrect, as captives typically provide coverage for their parent company or related entities, not unrelated third parties. Option C is incorrect, as reinsurance is commonly used by captives to manage risk. Option D is incorrect, as captives may have a private board of directors. Question 23. Captive insurance and tax considerations. Which of the following is a common tax consideration for a parent company when forming a captive insurance company? A. The parent company can deduct premiums paid to the captive as long as the captive is structured as a legitimate insurance company under IRS guidelines. B. Premiums paid to the captive are always taxable to the parent company, regardless of the captive structure. C. The captive must pay taxes on premiums received even if it does not generate any profits. D. The parent company can avoid all taxes on premiums paid to the captive if the captive is domiciled offshore. Answer A. The parent company can deduct premiums paid to the captive as long as the captive is structured as a legitimate insurance company under IRS guidelines. Explanation: for a parent company to deduct premiums paid to its captive insurance company, the captive must meet the IRS criteria of a legitimate insurance company, including risk transfer, risk distribution, and adequate capitalization. Option B is incorrect, because the tax deductibility of premiums depends on whether the captive qualifies as a legitimate insurance company. Option C is incorrect because captives are generally only taxed on profits, not on premiums received unless they generate income. Option D is incorrect as being domiciled offshore alone does not guarantee tax avoidance. Question 24. Captive insurance governance. Which of the following would most likely be considered a best practice for the governance of a captive insurance company? A. Allowing the parent company's executive team to have complete control over all aspects of the captive without any independent oversight. B. Appointing a separate, independent board of directors with expertise in insurance and risk management. C. Limiting the board of directors to members of the parent company's management team. D. Allowing only the captive's legal counsel to make decisions regarding its operations and financial strategy. Answer: B. Appointing a separate independent board of directors with expertise in insurance and risk management. Explanation: the best practice for the governance of a captive insurance company is to appoint a separate independent board of directors that brings expertise in insurance, finance, and risk management. This helps ensure that decisions are made in the best interest of the captive and not influenced solely by the parent company's interests. Option A is incorrect because independent oversight is crucial for effective governance. Option C is incorrect because a board made up entirely of the parent company's management team may lack sufficient objectivity and expertise. Option D is incorrect as legal counsel should advise, not solely control, the captive's operations. Question 25. Captive insurance and risk management. What is one of the primary benefits of forming a captive insurance company for a parent company's risk management strategy? A. The captive allows the parent company to provide insurance to unrelated third parties and generate profit. B. The captive enables the parent company to retain control over its own risk and tailor coverage to its specific needs. C. The captive eliminates the need for the parent company to purchase any commercial insurance. D. The captive guarantees that all claims will be paid without delay. Answer: B. The captive enables the parent company to retain control over its own risk and tailor coverage to its specific needs. Explanation: the primary benefit of a captive insurance company is that it allows the parent company to retain control over its own risks, customize its coverage to suit its specific needs, and potentially reduce the cost of insurance by self-insuring certain risks. Option A is incorrect because captives typically do not provide insurance to unrelated third parties. Option C is incorrect because captives do not completely eliminate the need for commercial insurance. They often complement it. Option D is incorrect because captives cannot guarantee that all claims will be paid without delay, as claims are subject to assessment and approval. Question 26. Captive insurance and regulatory reporting. Which of the following is a common regulatory reporting requirement for a captive insurance company? A. Filing quarterly financial statements with the State Insurance Commissioner. B. Conducting annual public shareholder meetings to discuss operations. C. Submitting annual premium payments to the state in which the captive is domiciled. D. Releasing a public earnings report to the media each quarter. Answer A. Filing quarterly financial statements with the State Insurance Commissioner. Explanation: captive insurance companies are typically required to file financial statements quarterly and annually with the State Insurance Commissioner or other regulatory bodies. These filings help ensure that the captive is financially stable and compliant with regulatory requirements. Option B is incorrect because captives generally do not have public shareholders, so public meetings are not a requirement. Option C is incorrect because while premiums must be paid to the captive, there is no requirement for annual premium payments to the state. Option D is incorrect because captives are not required to release public earnings reports as commercial insurers might. Question 27. Captive insurance and loss reserves. Which of the following is true about loss reserves for a captive insurance company? A. Loss reserves are used to cover future insurance premiums for the parent company. B. Loss reserves are established to ensure that the captive can pay for future claims and liabilities. C. Loss reserves are unnecessary as long as the captive is adequately capitalized. D. Loss reserves are only required for commercial insurance policies, not for captives. Answer: B. Loss reserves are established to ensure that the captive can pay for future claims and liabilities. Explanation: loss reserves are funds set aside by a captive insurance company to cover the estimated cost of claims that have occurred but not yet been paid, as well as those that may arise in the future. These reserves are critical for ensuring that the captive has enough financial resources to meet its obligations. Option A is incorrect because loss reserves do not cover future premiums but rather claims. Option C is incorrect because while adequate capitalization is necessary, loss reserves are still required to manage claims liabilities. Option D is incorrect because captives must maintain loss reserves just like commercial insurers. Question 28. Captive insurance and solvency. Which of the following best describes the importance of solvency in captive insurance? A. Solvency ensures that the captive will generate a profit in any economic environment. B. Solvency ensures that the captive has enough assets to meet its future liabilities, including claims. C. Solvency is only a concern for large commercial insurers and not for captives. D. Solvency is determined solely by the amount of premiums the captive collects. Answer: B. Solvency ensures that the captive has enough assets to meet its future liabilities, including claims. Explanation: Solvency is a key financial measure for any insurance company, including captives. It ensures that the company has enough assets and reserves to cover future claims and liabilities. Without solvency, a captive may face insolvency, which could lead to financial instability and an inability to pay claims. Option A is incorrect because solvency is about ensuring that the company can meet its liabilities, not about generating profit. Option C is incorrect because solvency is a concern for all insurance companies, including captives. Option D is incorrect because solvency is not determined solely by premiums, it also depends on assets, reserves, and liabilities. Question 29. Captive insurance and claims handling. Which of the following is typically part of the claims handling process for a captive insurance company? A. Captives often have a claims committee to review claims, assess risks, and approve settlements. B. The parent company handles all claims directly without any involvement from the captive. C. Claims are handled by third-party administrators, but the parent company has no input in the decision-making process. D. Claims are processed only after a thorough audit by the insurance regulator. Answer: A. Captives often have a claims committee to review claims, assess risks, and approve settlements. Explanation: Captives typically establish a claims committee which is responsible for overseeing the claims handling process, assessing risks, and approving settlements. This committee is made up of individuals with expertise in risk management, insurance, and claims adjustment. Option B is incorrect because while the parent company may have input, claims are generally handled by the captive, not directly by the parent. Option C is incorrect because third-party administrators may assist in claims management, but the parent company or the captive usually has oversight. Option D is incorrect because claims are generally not processed solely after an audit by regulators. Question 30. Captive insurance and investment strategy. What is a key consideration for a captive insurance company when developing its investment strategy? A. The investment strategy should prioritize high-risk, high-return assets to maximize profits. B. The investment strategy should be aligned with the captive's risk profile and liquidity needs. C. The investment strategy should be focused solely on short-term investments to maximize cash flow. D. The investment strategy should avoid investing in any securities, even low-risk ones, to avoid regulatory scrutiny. Answer: B. The investment strategy should be aligned with the captive's risk profile and liquidity needs. Explanation: A captive insurance company must develop an investment strategy that balances risk and return, taking into account its specific risk profile and liquidity needs. This ensures that the captive has sufficient funds available to cover claims while also maximizing returns within an acceptable risk tolerance. Option A is incorrect because a high-risk strategy is generally unsuitable for a captive, which needs to prioritize stability and liquidity. Option C is incorrect because focusing solely on short-term investments could jeopardize long-term financial stability. Option D is incorrect because captives are permitted to invest in securities, but their investments must align with regulatory guidelines and their overall financial strategy.